In this example video, we're going to look at exercise 6-7 and look at transactions that are related to when in a merchandising business you are the buyer in the situation. So looking at purchase-related transactions. So it tells us that our company is a women's clothing store and they purchased $75,000 of merchandise from a supplier on account. The terms are FOB destination, 210 net 30. So looking at each piece of this. FOB destination, there are shipping terms. So FOB stands for free on board, and that means it's free on board until it reaches its final destination. So FOB destination, free on board until it reaches its final destination, indicates that the seller of the merchandise is actually paying for the shipping charges. Had it said FOB shipping point, meaning it's free on board only until it reaches its shipping point, that would mean that the buyer of the merchandise would have to pay for the shipping charges. You also see credit terms, so it says 210 N30. So what that stands for, the 2 is a percentage discount that's being offered if it's paid, meaning the invoice amount is paid within the discount period. So in this case, we are being offered a 2% discount if we pay the invoice in 10 days. If we don't, the N stands for net, meaning any outstanding balance that's due is due within 30 days. So when we're looking at this, the key thing is to remember, if credit terms are offered in any variation whatsoever, we know that we've done that purchase on account. So even if it doesn't have that key phrase of on account, the credit terms are indicating for us that it's done on account because we are being told of when we have to pay for the merchandise that we've purchased. If a discount is offered, like the one in this case is that 2% discount, we are required to record that purchase at that discounted value. So in part A, they want us to record the purchase. So what we are buying is an asset. We are buying merchandise inventory. Again, the list price, if you think about it like the sticker price, is $75,000, but they're offering us a 2% discount, meaning we're going to record it at 98%. 100% would be the full $75,000. 100% minus 2% says that we're going to record it at 98% of that full or that gross amount, or at $73,500. And again, it tells us it was done on account, so we know that it's accounts payable. We're going to owe somebody that, of that $73,500. It also tells us that we returned $9,000 of merchandise, receiving a credit memo, and then we paid the amount due within that 10-day discount period. So in part B, they want us to record the merchandise that we've returned. So think about what happens when you go to a store and return something. One of the first things that sales associate is going to ask for is your receipt. They want to know, A, did you actually really purchase it? B, how much did you pay for it? And C, how did you pay for it? So if we look at this, we never paid yet any cash yet for this merchandise, right? We have this promise that we're going to pay sometime in that future. We generated that liability. So if we have not paid cash to this supplier for the merchandise that we've purchased, they are certainly not going to give us cash back. Same type of thing when you go to a store. If you paid cash, they will give you cash back for what you're returning. If you paid with a credit card, they're going to credit your credit card back for the amount that you returned. Same situation here. We want to reduce our accounts payable by the amount that we're returning. So that $9,000 represents that gross list price or that sticker price. But we recorded our inventory when we purchased it at the discounted value. So if we recorded it initially at a discounted value, we have to reduce for what we're returning at that discounted value as well. So our 9,000 times, again, that 98%, we're reducing how much we owe by $8,820. And what I'm giving back is my merchandise inventory of $8,820. In Part C, they said we were able to pay within that discount period, so within that 10 days. So what we need to do is reduce our accounts payable. We're paying off our debt. We originally owed $73,500. We returned $8,820 of that. So the balance in our accounts payable account is the difference between the two. So we owe them $64,680. And to pay off our debt, we have to pay them cash.